So good evening, everyone. Today we're going to talk about how COVID has impacted the real estate market. Similar to many industries, the pandemic has had a significant impact on the real estate market, and our three highly experienced speakers will discuss the current environment for real estate investment. Our first speaker will be Berzin Bhandara. He owns and manages a significant portfolio of the commercial real estate holdings of his family's real estate company. He is a co-founder of the NW Crossing Management Group that manages commercial properties in Houston. He's also the vice president of the Ardenwood Group and oversees the day-to-day management of 13 office buildings, apartment complexes, and shopping centers. So good to have you, Berzin. Then our next speaker is going to be Nozer Buchia, who is an internationally acclaimed motivational and inspirational speaker. He has authored books such as Why Entrepreneurs Really Fail and Roadmap to Success, which he co-authored with Dr. Ken Blanchard and Dr. Deepak Chopra. Nozer has been deeply involved with commercial and residential real estate for many years, and I'm sure he'll have a lot of good strategies to provide to us. So welcome to you also, Nozer.
Thank you.
Then our third speaker is going to be Zal Sethna. Zal started his very successful career at New York Life as an agent in 2009. And currently he offers a variety of products to meet financial needs such as college funding, retirement planning, lifetime income strategies, and long-term care. He was also an administrative manager for multiple offices of New York Life from 2014 through 2019. And Zal will provide us with strategies such as how life insurance can be used as collateral for real estate investments. So that should be very interesting for us to hear. So please use the chat function in Zoom to enter any questions that you may have for our speakers. And once the speakers have presented, we will go through the questions that are in chat. With that, I would like to welcome our first speaker, Mr. Berzin Bhandara. So Berzin, take it away.
Yes, absolutely. Thank you to the WZCC for inviting me to speak about COVID-19 in the real estate industry. I'm very honored that you guys see me as an expert in this field, and I owe all of my knowledge to my mother and father who are watching. So hopefully I do them proud with my presentation. And I have prepared a PowerPoint presentation that I will share. And if at any time anybody cannot hear me or cannot see, please let me know. I'll start the PowerPoint right now. Okay. Let's see. Great. Okay, if everyone can see the PowerPoint, please confirm.
Yeah, we can see it, Berzin. Thanks.
Okay. And let me see if I can move this. Okay, there we go. So what I'm here today to discuss, and what we're all here to know more about, is COVID-19 and its effects on the real estate market. My expertise falls mainly in the commercial real estate market, not so much residential. So I will provide my insight on the effects it's had on the commercial real estate market. A quick introduction of myself. I graduated from the University of Texas in 2006 with a bachelor's in business and a master's in accounting. I also passed the CPA licensing exam in the first year, and I continue to hold an active license, although technically I'm no longer a practicing CPA. I did work with the global firm Deloitte & Touche for 4 years, from 2006 to 2009. I worked in their real estate practice, performing what's called acquisition audits for real estate firms. And then in 2009, I joined my father, Feroz Bhandara, as the vice president and CFO of the Ardenwood Group. And as Jal mentioned, we own and manage about 15 commercial properties across the Houston area. We also own a 432 unit apartment complex, and we also have a 200-acre real estate tract in Katy, Texas, where we're planning a master planned community. Before we get into COVID, I wanted to step back and kind of, refresh everyone as why do we invest in real estate? Why do individuals enjoy and strive to invest in real estate? And I wanted to go over some of the pros of investing in real estate. Real estate itself, it's tangible, it's easy to understand. Everyone lives in a house, or they work in an office, or they have some sort of relationship to real estate. So given that everyone's daily relationship to real estate, it seems like a very viable option when investing. There's also the promise of stable returns with the opportunity for rental growth. Think about that first day of the month where everyone is giving their rent payments, and you can, people consider those stable returns as being very safe. Real estate, unlike some financial investments, they're backed by hard assets. When you think about the land, the building, the property inside of those buildings, if you compare that to, say, stocks or bonds, a stock price can go to zero, a bond can default, a private equity investment can fail and go bankrupt. So I think sometimes people like the fact that you have these hard assets backing you with real estate. Additionally, real estate sells at very attractive multiples, and while a successful business may sell at 5 times earnings, a successful real estate investment may sell at 10, even 15 times earnings. So the opportunity to multiply your investment can be high with real estate. Real estate can also be a good hedge against inflation. And me personally, I feel like, unlike the stock market or private equity, I feel that people like real estate because it provides investors with a sense of control over their outcomes. You can go to the property, you can really work on it, you can improve it, you can get new tenants. The main sectors of commercial real estate, and of course, there are subsets of these sectors, but the vast majority of property types falls within these sectors, and we're going to come back to this slide later. But our office, industrial, think of warehouses and shipment fulfillment centers, retail shopping centers, medical, which can include hospitals, medical office buildings. Then you have multifamily apartments, and you have development, whether that be ground up development, redevelopment. So we were all very shocked last year right around this time when COVID changed our lives, and how has COVID changed commercial real estate? Well, when COVID-19 first hit last March and we had the shutdown in April, it was sort of like a twilight zone for commercial real estate. You had all these buildings that you had worked, for years and decades to fill and be successful. They emptied out overnight. It was a very surreal feeling to walk into buildings or go by and drive by buildings and see them completely shut down. Everyone at that time in the commercial real estate industry was afraid. They didn't know what was going on. Like everyone else, they were vying for federal stimulus. We applied for PPP loans, and I actually helped a number of tenants apply for their own PPP loans, trying to help these businesses survive. Companies were looking for concessions. Rent was not being paid. it was just a very scary time. Companies were filing bankruptcy, but for commercial real estate owners, the expenses never stopped. The mortgage had to be paid, property taxes had to be paid, the electricity had to remain on, maintenance had to be kept up. So it was a very uncertain time. Of course, over the months as the lockdowns relented, things turned back to normal. But what you saw was a complete shift in the landscape of the tenant-landlord dynamic and the dynamic of just working in an office place. You saw a dramatic shift to a new digital landscape. And this was brought upon mainly by, companies' needs for immediate shedding of their physical location costs. As their revenues decreased, they had to figure out how to trim the fat. And it was easy to look at items such as rent, utilities, property, and equipment. And so you saw a lot of companies coming and talking about downsizing, or talking about concessions, or talking about early terminations. The stay-at-home orders, what it did was it mandated that employees must stay at home, but these companies needed to keep working. It forced these tenants and companies to adapt to keep their businesses alive. One of the things they quickly learned how to do, of course, was utilize technology for their operations. Of course, Zoom was a huge technology breakthrough for companies that allowed their employees to work remotely. You had other very good software systems out there, such as Slack, which combined all of the messaging between employees, as well as software such as Google Docs, which allowed employees to operate and collaborate remotely. And what did this do from a commercial real estate perspective? Many companies realized that they could do more with less. And so what you're seeing is a trend, especially in the office and the retail sectors, of downsizing and utilizing technology and keeping employees, if not completely remote, at least partially remote. And this is a big deal for landlords that relied upon seats in the chairs in these offices in order to justify these companies spending large amounts on rent. So 1 year on, we're still dealing with the fallout of this new digital landscape. And we feel that the landscape is changing in certain respects for good. Now, as everyone knows, we are all humans are capable, and they adjust, and we're going to figure things out. But right now, we're still trying to figure out our way. From an owner's perspective, what happened? What was important for us? Cash flow during COVID-19 was critical. If you had swaths of tenants not paying rent, you had to figure out how to survive. You had to figure out how to navigate the concessions that were rampant, that tenants were demanding. You had to figure out how to successfully negotiate downsizing and bankruptcies that tenants were going through. Many tenants were coming and asking for new deals on their leases, and one of the lease deals they were asking for was what's called blend and extend, where they'll ask for 6 months free rent now, or several months free rent now, with the promise to pay it back later. We did everything. We had to do what it took to ensure that our occupancies remained high enough to satisfy our expenses. But we also accepted that we would lose tenants, and we did. But I think the most important thing is the last point, that we kept our powder dry, and we planned, and we saved, and we made sure that we'd be ready for the rebound. And that rebound is coming. We see the rebound on the horizon. I think the US just hit more than 50% of its population having some sort of vaccination. And I think that is a psychological breaking point where people are starting to take more risks and come out. So, you know, the successful real estate investors are going to be ready for that rebound when it comes. This, touching back on a slide I showed you a few minutes ago, this kind of just shows the impact on the different sectors of real estate. Office, of course, in my opinion, was hit the hardest. You had companies in office that were the most likely to go digital. They were the most likely to ask for concessions. They were the most likely to require downsizing. We believe office is going to be the longest road to recovery. Going down to retail, retail also had some major setbacks, especially during the lockdowns. You had centers that had not a single shop open, not a single tenant able to pay rent for 2, 3, 4 months. And this was a big struggle for landlords. Retail is starting to recover, and it could be an interesting play for investors who are innovative and who are aggressive. Going to industrial, the outlook for industrial somewhat improved during COVID. If you think about Amazon and all the fulfillment centers and warehouses and industrial centers, they benefited from online, from the advent of online shopping and online business, and they saw an uptick in valuations and sales. Medical, being an essential service, also did well. Multifamily has been on fire for many years. This is mainly due to very low interest rates, the low interest rate environment that we've been seeing, as well as high occupancy. Apartment complexes enjoyed 92+% occupancy over the past 5 years. And people still needed a place to live during COVID. And there were so many services available to apartment dwellers during COVID. You had federal stimulus, you had local city and state stimulus. There was also a moratorium on evictions. So, you know, the occupancy stayed very high during COVID. And so you saw the valuations of multifamily stay very high. I'm not going to speak on development very much because it's not my expertise, but I will say that for the most part, certain sectors of development were redlined. You do see a lot of, you're still seeing a lot of development in residential tracts, although I'm not going to get into that too much during my discussion, but the new single family home development and sales has remained very strong, even during the pandemic. So now what everybody wants to hear about is investing during COVID-19. Yes, it is possible. The federal stimulus that we spoke about earlier, plus low interest rates, plus loan workouts have generally meant less deals in the market during COVID-19. You still haven't been able to find the same deals that we saw during the 2008 to 2010 crisis. I think the main reason for this was sellers saw COVID-19 as temporary. Therefore, valuations and sale multiples did not decrease as much as sellers expected. So there was still a divide between what sellers expected and what buyers expected to pay. During COVID-19, you have to, as an investor in real estate, no matter what type of investing it is, whether it's in office or retail or homes or any type of other investment, it's going to require a higher degree and higher level of scrutiny. You're going to really have to study all the due diligence. You're going to have to do a lot of due diligence. You may have to extend your due diligence periods. You're going to have to go the extra mile to find out information on the tenants in that property. There was a deal that I was looking at a few months ago where I literally picked up the phone and I called every business in the center to see if they were still open. Some of the tenants told me they were closed and that they were no longer going to be operating. And that was contrary to the rent roll that I received. So you have to be careful and really take your time and look at the data. Banking and financial relationships are key. Certain banks are no longer lending on certain types of real estate. So maybe that banking relationship that you had 2 years ago, you may want to double check in with your banker and see, are you loaning on retail? Are you loaning on office? Are you loaning on hotels or motels? Are you loaning on single family development? And the answer may surprise you. They may tell you no. So you'd have to go to other financial relationships to see how you can get your access to capital. And just looking at your prior assumptions and just understanding that they must be altered for your new reality. You have to look at if you're into pro formas and data, you have to understand it may take a lot longer to find that new tenant. It may take a lot longer to fill up that building. And that affects values. That affects what you can pay for a property. And the last point I wanted that I'm making here was, beware of the unscrupulous seller. There's a lot of unscrupulous sellers out there that are banking on the fact that you won't do your due diligence. And I mentioned before that I made direct phone calls to tenants when doing due diligence, and those are called ghost tenants. Another phrase for that is dark tenants. Beware of ghost and dark tenants, and be very aware of pro forma cap rates. That means that the seller is trying to entice you to buy at a higher valuation, even though their rent roll doesn't justify that valuation. They're selling you basically a bill of goods based upon a dream. So you have to beware of these things. And finally, how should I invest during COVID? And this is kind of just a general questions to ask yourself before investing. Number one, what area of commercial real estate interests you? Perhaps a certain area interests you more. Maybe you like retail because you used to be in retail sales, or maybe you like a hotel or motel because you used to work or have some sort of relationship there. So just figure out what type of, because they're all different and they all require different management styles. So figure out which area interests you the best. Also look out for what kind of risk profile do you have. There's two different types of real estate investments. There's what's called prime or investment grade, and then there's what's called value add. Prime or investment grade, that has a much lower risk and you pay a premium for that. But that's like, for example, investing in a shopping center that has a Starbucks and a Verizon store in it. You know that those are top quality tenants that have long-term leases, and you consider that to be lower risk, whereby you might buy a half-empty office building, and that would be considered a value add investment at this time. It's a lot riskier. You also have to think about what kind of investor, how fast do you want to cash out of your investment? Are you looking to buy and hold, or are you looking to flip in 2 years? And different types of investments, different types of investment strategy require different investment types. So you have to figure out what kind of investor you are, long-term or short-term. Then ask yourself, do you see yourself doing this full-time or part-time? Full-time could save you some money because you could take on the management. Part-time will provide you with less headache, but you'll get a lesser return because you may have to hire a management company to assist you with managing the property and getting leases. That also goes to active or passive management. Do you want to roll your sleeves up and get your hands dirty, or do you want to let somebody else do it for you? Typically, a management firm charges about 4% of revenues. So just think about that when you're looking to hire a management firm, if you're willing to give up that 4%. The most important aspect of investing during COVID is, do you have the stomach and the wherewithal for short-term losses and or expensive repairs? You should always go into any investment thinking that you're going to have to keep a reserve. You should budget for that reserve, and you should make sure you stick to that reserve, especially during this time when you have such fluctuation in your tenants. You have to be prepared for the short-term losses and wait for the rebound. Also, less important is software considerations, but just to let people know, these days there are a multitude of software options that allow you to manage remotely. I'm pretty familiar with all of them, and I'd be happy to give recommendations if anyone is interested. And that is pretty much my presentation. I thank you for listening.
Thank you, Berzin. That was really informative. Appreciate it. Nozer, you want to go next?
Yeah. I think Rustam Engineer is going to bring up my screen. I need to thank him for doing that in the last 15 minutes that I bothered him. So thank you, Rustam. You've come to my rescue. So very quickly, like Zal said, I have, besides being an international speaker and author of 3 books, and I take companies and individuals and turn them around. Been in business for 43 years, and I do a ton of real estate. We have 2 brands of real estate under our real estate group. We also have a private real estate investment company, and that is all done by ourselves. But we also formed another consortium with 2 other individuals, an investment banker with 45 years of experience and an attorney with 30 years of experience. And my whole concept about COVID is completely different, and I'll tell you why. The real estate market in the COVID area. If you could just go back one more slide, Rustam, I'm sorry. Yep. There are only 3 things that they're focusing on. There is a ton of opportunity right now. Our company is very bullish on this, and it's very unfortunate to say that, but COVID has really boosted our profitability high, and it's very capital intensive. And I'll explain to you what I mean by that. The reason for that is what I've highlighted below. There's lack of inventory in the market, residential, commercial, anything that you can talk about, and I'll touch upon this quickly. Interest rates are very low, and people are trying to jump to the banks, and I'll tell you in a minute why you may not need a bank anymore to work your commercial deals or residential deals. And there is a surge in sales. So we divide it into 3 parts: residential, commercial, and investments and capitalization. So the next slide will tell you about the residential part. So new home construction has surged in March 21. And as you realize, especially in Houston, everyone compares the real estate market going up or down with how the residential sales go. It's not a true measure, but that's how people do. So if you look at the second line there, a total of 9,347 single family units were sold in March, compared to only about 7,500 units in the same time last year. And if you look at the new construction, just to give you an idea, in the Midwest, it surged 122%. In the Northeast, it jumped 64%. And in the South, where we had a gain of 13%. And I'll also touch upon why that happened. But the West, and this is very important, on the West side, the housing pace fell by about 13%. And there is a reason as to why that happened. We'll touch upon that in the slides to go. So let's go to the next one. If you see new residential construction, you see the blue line indicates the permits, the darker blue indicates the starts, and the green indicates the completions. So if you look at March of 20, everything was down. Starts were down. There was no permitting, virtually zero permitting, or I should say very little. And completions were completely halted thanks to the pandemic that had actually spread. And this is a very latest Census Bureau from HUD, which is on April 16th. And then if you see March 21, you can see how in thousands of units, this has just absolutely jumped. So if you go to the next slide tells you building permits just in March 2021, 1,700,000 building permits were issued. 1,700,000 housing starts. 1,500,000 housing. This is all Census Bureau information. This is not anything that I've made up. And like I said again, in the Houston market, people compare how bullish the market is, comparing it to the residential construction, the residential awareness, and how the residential market functions. So let's go to the next one. And I'm trying to cover the different areas. Then I'll talk, once we close the site, I'll talk a little more about what we do and how this is the best time frame for us. So commercial expected foreclosures. Now let me forewarn everybody on this call. This commercial expected foreclosures are what our company has actually got till date. This is live data that we have. So we have in our portfolio hotels totaling approximately 400 million that are going to get foreclosed. We have that portfolio. We work with banks, we work with sellers, we have that portfolio, and that is expected to be approximately 2 billion and rising. And I repeat again, this is not data from the market. This is what our corporation, RAM Global Enterprises, that's our investment and financial stability company. We have got hotels totaling 400 million that are expected to go into foreclosure in the next 3 to 5 months. We are working with those sellers. We are working with the banks. We're trying to see how we can help them. And I'll tell you in a minute what RAM Global Enterprises does and how we are going to be able to help them. But that is going to be approximately 2 billion. We have approximately 200 million of multifamily going under. Once again, I keep repeating, this is what we have. We have got these portfolios available to us and we are working. This is expected to be 1.6 billion and rising. Office buildings, it's a mess in the office building industry and retail. Those two are a mess. We've got about 450 million of office buildings right now, and it's expected to be 3 billion, and it's expected to be rising. And I think office buildings and retail are the two that have been hit the hardest. But again, remember, these are expected foreclosures. And what our company is doing is we are working with sellers, we are working with the owners to try and see, because one of the two things that everybody in the real estate industry or even in the financial industry is worried about, that their credit should not get impacted. So if you get into foreclosure, obviously your credit is impacted. We are trying our best to see that our credit does not get impacted in times like this. And that's how we are going to help sellers. Banks are very eager to work with us. And banks are telling us that, hey, you know what? We're not in the business of real estate. So I'll give you an example. Let's say if it's a $50 million hotel and the banks have got about, say, $20 million loaned against it. We are restructuring those loans with the banks, and the banks are going to sell those properties to us. And then we are going to, in turn, help the sellers at probably 20 or 30 cents to the dollar, sometimes even lower. So that brings me to the next slide, which is the third part of what we do. So remember, one was residential, one was commercial, and the third part, which is probably, I think, the most important part in this whole COVID situation, investments, funding, and capital restructuring. So right now, RAM Global Enterprises, which is my company with my two partners, we have approximately $500 million of opportunity in hand that we are going to either fund or we are going to do capital restructuring for. The pipeline that we have till date from today up to the end of the first quarter of 2022, we have a pipeline of $2 billion that will be funded by our corporation, and that pipeline is increasing day by day. International, so the question is, how are you going to fund all these deals? These numbers are massive and these are huge numbers. So let me explain to you. International investors in India, China, Middle East, Turkey, Indonesia, Venezuela, London, Australia, where I lived for 7 years. International investors, wealth advisors, financial planners, and mainly family law offices are sitting on billions and billions of dollars that they need to place. They are not able to place that money. They're just not able to place the money. So this is what we have done. And again, I repeat, the reason I can confidently say this is because we are actually doing it. We are living it right now, which is why we moved away from all the asset-based structuring to financial structuring or capital restructuring. So this is what we do. When a person comes to us, so the 500 million opportunities that we have in hand right now, we are actually assisting, and I'll give you just a few examples. There is a whole town center development being done in Conroe, a new town center development being done there. Chevron is going to open up a new office over there, going to move about 10,000 people around Conroe. And there is an $85 million development coming there, which my organization is going to fund 100%. So when we fund these developments, we have a structure, and this helps because of COVID. We came up with this whole platform idea, and knock on wood, it has completely mushroomed into something bigger than what we even expected. So we fund 100% of all developments, 100%. All our lending and all our capital restructuring is based on the asset. It is not based on the individual. So there are no personal guarantees, no prepayment penalties that are required. We get 2 seats on the board of the corporation that actually is borrowing the money from us. We don't run the company, we don't manage the company, we oversee the operations of the organization. And contractually, we have a whole process and a whole procedure which the organization that is borrowing the money needs to follow. And if we realize that that is not being followed, then we jump in and we take over the entire project. And there are many people in our group, including myself, who've run multi-million-dollar companies, so we know exactly what to do. Also, the other thing that is really, so that's just an example of a Conroe 85 million. There is a developer that is building 2,600 homes in near Galveston. 2,600 homes. It's an approximate $75 million project. We are going to fund that entire project. It's going to be a 12-year project. There are going to be 4 assisted living that we are funding right now. There are 2 apartment complexes that we are funding right now, ground up and development. The reason I'm throwing all these numbers around is to drive home a point. It's now that's the best time to either buy, sell, or invest. Now is the time. And one of the things that has unfortunately happened, I don't know how many of you have read this, but this whole PPP that has been given, the money that has been given to business owners, a lot of those business owners have abused that money. I don't know whether you read today, but in Texas itself, there was an individual, unfortunately, he's from India, he's an Indian gentleman who misappropriated $24 million from PPP money, and he's now going to be in jail for 30 years. There are 3, and it's all in the news. There are 3 other people that have been caught misappropriating money. And the reason they started doing that is because banks have had a freeze during COVID, which is why our business completely mushroomed up. And even today, banks are very skeptical about loaning against retail. Retail is virtually gone to hell in a handbasket, virtually. The buildings, office buildings, same thing. People are struggling with the office buildings, which is why we have an opportunity. But I will tell you this, the financial planners and international investors, wealth advisors, everybody that we work with, and I know that the next speaker is going to talk about insurance, but a lot of the insurance financial planners and insurance advisors world over are reaching out to us, telling us, we want to extend our portfolio into the real estate market. How do we do it? What are the benefits of investing with you guys? Because you guys are controlling now, hopefully everything going well, about $2 billion of market cap. So COVID has devastated a lot of things for a lot of people. Rustam, you can get out of the slide if you want. COVID has actually devastated this for a lot of people, completely devastated. But for our business, it has been very good. Our investors are very, very happy with the money coming in. And last thing I also want to mention is there are new government programs that have come up. One of them is the EB-5 program, which has been there forever, where you need a green card and you create certain amount of jobs and invest in certain amount of real estate or certain corporations, and your family gets a green card and your immediate family comes here to the United States. There are different projects, there are different opportunities that the government has come up under the EB-1 and the EB-1C scheme, which we are doing. And I know some of the people on this call own several Kentucky Fried Chickens or Taco Bells or Burger Kings. We actually have a program in place through the government, and one of my partners is an attorney, where you get money to help somebody from a different country come here and extend their stake in the United States economy. And that money is given to you for 4 years. You replace that money only after 4 years. You use that money to grow your franchise business. So right now we are working extensively with Marco's Pizza. We are one of the selected people to work with Marco's, and Sonic. We are the selected people to work with Sonic. And we're working with Kentucky, we're working with Salata, we got a lot of different chains. So COVID has actually helped us tremendously. And I think instead of the doom and gloom that people are facing, I think the real estate market, the investment market is on the rise. Investors are seeking more and more opportunities. We provide those opportunities to investors. More and more wealth advisors are coming to us saying, we got $100 million, where can we place and how can we place it? And those people are not looking for the 10 and the 15 and the 20% return. They're looking for 3%, they're looking for 4% return, which is the advantage that we have. They get that 3 and 4% return, we charge a higher return, we keep the difference, we manage the entire project. But we can get millions of dollars funded. And if you remember my slide, we have 500 million right now available right now, and we're funding that. And then 2 billion in the next 1 year to all the financial planners and international advisors world over. So I'll leave you guys with two things, and in the question and answer session we can talk. Investments, I think I have not seen a better time to get into investments than now. The only thing you have to be very careful about is there are many scam artists available out there. They will take your money and disappear and you will never see them again. So you have to be very careful who you invest with. Be very careful how you invest your money. Contractually, have your attorneys look through every single thing. Do not be slopshod just because you want to invest your money. So that's one thought that I will leave you with. The second thought is the way the COVID trend has helped develop multiple financial strategies. One of them being our company, RAM Global Enterprises. Banks are going to have a hard time because banks require all sorts of personal guarantees. And if you go to a bank to get a $25 million deal funded, and then you have another $25 million deal funded, you're going to have a big problem giving so many personal guarantees. Now you start borrowing personal guarantees from other people. Our group, our corporation has done away with that. It took us about a year to build this entire platform. And now that the platform is built, I think that this is the best time for our company selfishly and for other people in the commercial real estate space, in the investment and capital restructuring phase to get in. And we can talk more about it. I know we're running short of time. We can talk more about it when we get into the question answer phase. So over to you, John.
Thank you, Nozer. Zal, can you go next?
Yeah, I'm ready.
Okay, great. Thank you.
Okay, so hi everyone, I'm Zal Sethna. As Jal said, I'm going to be talking to you a little bit today about life insurance and how it applies to the people who are interested in real estate investing in ventures, etc. So, brief, history about me, as Jal stated. I started at New York Life in 2009. After college, I went to Texas Tech, graduated with a business degree. Was an agent for a few years, then a manager for different offices around the country for about 4 or 5 years before I came back and joined Dad back here in Houston. So Berzin and Nozer Uncle both stated that lending from banks in this environment, it's become more difficult, right? So what I'll explain briefly is just the what the expectations might be on the life insurance side when you decide to take part in a real estate venture. So let's just say you have, for example, two business partners. They decide to take part in a real estate venture together. Well, those partners may take out a bank loan, right? Or they may take out a SBA loan. So for those that aren't very familiar with SBA, what that stands for is the Small Business Administration. It's a government agency that would help entrepreneurs and small businesses secure a business loan. So let's just, for the sake of this discussion, just use $1 million for a real estate project. There's a chance that whoever provided that loan would want that loan repayment to be secured, even in the case of a partner or both partners' death. And that's where life insurance would come into play, and more specifically, something called a collateral assignment. Okay, so what a collateral assignment is it's a conditional assignment where the lender would be the primary beneficiary of a policy in case of the death before repayment. So usually a business will own that policy, and the collateral assignment will be in place to make sure that the bank gets whatever the loan balance is if one of the or both partners were to pass away. And whatever the loan balance is the important part there. So if the policy is for, if you took out a $1 million policy because initially you took out a $1 million loan and that's what the bank said that you needed, and then you reduced the loan down to $500,000, and something happened where one of the partners passed away, the bank would only receive 500,000. They would not receive that full $1 million that was part of the original policy. And that's what the collateral assignment does, is it'll make sure that the bank only gets what's owed. Okay. And that's kind of the basic concept of a collateral assignment. So, moving on, let's say that the loan has been paid and you still have the life insurance and loans paid off. You no longer need the collateral assignment, and one of the partners dies. If one of the partners dies, the spouse may not necessarily be interested in being a part of the real estate or business venture. So in that case, you would have something that's called a buy-sell agreement. So we'll go over a couple types, but the first one I want to talk about is what's called the entity purchase. And that's where the entity would be the owner and the beneficiary. So the amount collected from the insurance with the result of one of the partner's death would then be used to buy out the partner's share of the business that would have belonged to the widow or widower. Okay, so partner dies, and so then the life insurance would then be used to buy out the other partner's widow or widower, assuming they no longer wanted to be part of the venture. Okay. If there's only two partners, a lot of times there's many partners, but if there's only two partners, there is a buy-sell agreement that's called a cross-purchase agreement. And basically what a cross-purchase agreement would be is it's a policy where partners take policies out on each other, making the other a beneficiary. So if partner A takes out a policy on partner B, partner B would then take out a policy on partner A. So that way, if partner A dies, partner B would get the funds from the life insurance policy. And that money can be used then to buy out the deceased's interest. So from a general standpoint, this buyout would not cause a taxable event. So a note about the cross purchase, because you are buying life insurance on the partner, this usually works out best when they're around the same age, right? Because if I'm in my 30s, my partner's in their 60s, the premiums would be dramatically different, yet the face amount would be potentially the same. So that's where the cross purchase would come into play. Okay. And then one final idea that doesn't have to do with the buy sells or collateral assignment. It's a concept, and it's a concept called estate equalization. So it's more so for if someone has a business or property owner has multiple children, and only, let's say, one of those children decides to take over the business and the property that business is on. Well, then one solution to keeping the home happy would be to have a life insurance policy of a similar value to the real estate and or business. Whereas when the parent passes away, the beneficiaries would be the other children, and those other children would then get a sum of money. So that way, everyone, people aren't fighting over the business and or property after the parent passes away. And that's just a concept called estate equalization. So as was stated, in these times of COVID where things have become more difficult, maybe getting a loan would be more difficult, you will oftentimes see banks want to have some sort of collateral assignment in case something were to happen to the borrower. Okay, so that's just a little bit I have for as far as how life insurance can play a role in this environment.
Thank you, Zal. That was very helpful. There's a question in chat, and I think you've addressed it somewhat, but it's basically asking if you typically see a requirement from the SBA about using life insurance as collateral.
So I wouldn't say it's for sure every time, but what I would say is that it is often. So oftentimes you will see a bank or SBA want life insurance as some sort of collateral, but it's not necessarily going to be every time.
Okay.
It would depend on the bank, I would say, and the individual.
Okay, thank you. So folks, we have just a few more minutes. I don't see additional questions in chat. So if you all would like, you can unmute yourself and ask the question directly, or you can write it down in chat, and either way, whatever is easiest. Okay, so if there's no more or no questions.
I have a question for Zal.
Yeah, please go ahead.
These, when you're talking about a cross-purchase agreement or a collateral assignment, are these typically term policies that are taken out, or are they other types of policies?
Many times with the cross purchase agreements, I have seen them as term policies. So I think it would, like most life insurance, depend on a case-by-case basis and what the overall goal is. But I have seen the majority of what I've seen has been cross-purchased of term policies.
Thank you.
I have a question about the cross-purchase agreement. I was wondering when you talked about there's no tax impact. Could you explain that a little bit more, please?
Yeah, so we would want to think of that in a general term. So in generally, there's no tax impact if, for example, me as I've already paid taxes on and I'm using my, my personal funds for paying the premium. So if I'm using money out of my personal account, I've already paid taxes on the money that's come into the account, then I don't necessarily need to, I won't need to pay taxes then when there's a, on the death benefit, because traditionally life insurance death benefit is tax-free. Now, if you're doing something different, it has to do with the company paying the premium and different types of, something like in that sense, then there could be potential tax consequences. But from a general standpoint, if I'm paying the premium from my bank account, say, and the money's coming after I've already paid taxes on it, then then the death benefit would be tax-free.
So my question is more particularly, just to clarify, is it the insured who doesn't have to pay taxes because that insured's money is going to pay the death benefit to the person to the family of the person who has expired?
Yeah,
Is
both
that-
ways, because
Both ways.
both business owners have bought policies on each other, so that would work in the same way.
Oh, okay.
So yes.
Okay. And can you talk more about estate equalization, please?
Estate equalization, that concept was mostly like I own a business and I have children. And one of my children is going to take over that business, take over the property that business is on. And my other children have no interest in that. They have other dreams, goals, and they have other areas that they've pursued. So I take out a policy. I have a life insurance policy taken out on myself, and I've passed down the business and the real estate, all that the business was on, to the child that's going to take over the business, basically. And I make the beneficiaries of my life insurance policy the other children. And that way, when I do pass away and, child one gets the business and whatnot, the other children don't necessarily feel left out, or that they've gotten, that they haven't received something that they're privy to and start trying to interfere with the business, etc., that they may have had no interest in while the parent was alive.
And it is completely separate from a regular life insurance policy, I would imagine. It's a
It would be-
special.
Actually,
coverage.
that's more of a concept. So it would be like a traditional life insurance policy, and most likely like a permanent policy.
A permanent as in not term life.
Right, because if it's a permanent policy, then there's more of a guarantee that the individual will die and life insurance proceeds will pay out. If I have a 20-year term, after the 20 years, if I'm still alive, then that concept doesn't really work.
Interesting. Thank you.
You're welcome.
I would imagine that it would be a very expensive policy if it's whole life, wouldn't it?
It depends on multiple factors, age, as well as your health and what type of permanent policy. There's many different types, so it really just depends on the individual and how much.
Okay. This question is for Bhandara. You talked about software considerations for management. Can you give us some pointers on that, please?
Sure. Could you give me an idea of what property type you're interested in?
For commercial.
Okay,
Like-
sure.
or
So-
office type structures?
Office type structure, sure. With the advent of online and online software, the industry has come up with very powerful tools or very powerful softwares that used to be these canned softwares that you would download and you can only use it in certain ways and only one person can use it at a time. Now you have softwares such as one is called AppFolio. And AppFolio is a very powerful software that can be utilized online. It's used for office management, retail management, multifamily management. It's extremely user-friendly. You can have as many people using it at one time as you want. You don't have to pay for additional licenses. They just charge you by the unit. It's almost like an a la carte. And so I always recommend AppFolio as a perfect starter software system for real estate investors.
So it's for all applications, not just for commercial. You can use it even for multifamily.
You can use it for multifamily. You could even use it if you say own 5 or 10 rent houses. And yeah, so you could certainly utilize the software for lots of different purposes, and it's fairly cheap. Again, you pay almost a la carte by the unit. I would highly recommend AppFolio software for real estate management. And it also has another feature that all the other softwares do not have. It comes with a free online payment feature where your customer gets their own customized portal and they can set up their own credit card or bank account payment. And they do that absolutely free as part of your subscription to the software package. All the other ones charge you an arm and a leg to give you the right to do that. And this is the one that doesn't.
Okay, one follow-up question. Besides for management purposes, do you have any recommendations for software that does analysis for buy-sell deals?
I personally have created my own proprietary software that not software, but analysis just on an Excel sheet.
Does Excel?
Yeah, you can do anything and everything on an Excel sheet, just utilizing the right formulas.
I was just wondering, that's what I would typically do if I was to analyze something, but I'm just curious, have you come across any decent software that you would trust?
I have not, but I suppose that the larger real estate investment firms probably have their own, where they put in their deal terms and it comes out with the valuation that they want to see on a deal.
Okay, well, thank you.
But I do everything in Excel, and most of the people I know do it that way as well.
Nozer, this question is for you. You talked about this being the best time to invest. Is your question, is your comment slanted towards the fact that you're obtaining all the capital from private entities and not from banks at all?
Yeah, we are obtaining, yes, that is true. We are obtaining our capital from private investors, international and otherwise. And one of the things that I omitted to mention is we also have private investors locally here in the United States, where we have created a consortium and a syndication of those investors. And the best time to invest now is because you can get capital freely available. The people that are wanting to invest in projects, they don't want a massive rate of returns. They just want their money to be put to use. So Jahangir, just to give you an example, right now, and I may be off a little bit here and there, but I'll try and give you the conceptual idea. From the 1 year of analysis and the analytical tools that we have built, we find that there is about approximately, and I'm just giving an approximate number, about $250 billion that are actually waiting to get into the United States. And the residual returns that they want on that money is in the single digits. So when we can take that investment and we can make 20, 30% on that investment, and we are paying 6, 7, 8, 9%. If I give an investment firm in China 9% as a return, he will virtually touch my feet. Because if you give them a 3 or 4%, they're very happy. So we have devised our groups into two categories. One is the massive guys that come up with 100 million, 500 million investments. Those are wealth advisors, planners, law offices. And then the smaller groups. So the smaller groups can come up with 100,000, 200,000, 500,000, doesn't matter. Because when, this is, I think, a short time for me to explain, but the concept that we have is when you are coming to us and asking us for $100 million, there is a certain protocol that you need to follow. The legal fees and etc. have to be borne by the person that is doing the borrowing. They are asset rich, cash poor, they don't have that money. Our smaller investors fund that money and they get their 10 and 12% return. So we are not only helping the smaller investor, we are helping the larger developer. Like I mentioned, the 2,600 homes that they are building on 1,100 acres, it's a massive development. There's another big developer that is doing nothing but multifamily. But the same concept is investors want their returns to be secure. We give that security to the investor that their money is going to be absolutely secure. And we also give that comfort to the developer that you don't need to go to a bank and ask for 100 million. First of all, it's going to be very difficult to get it. You got to go to a hedge fund. Hedge fund will want 95% of your project if they want to fund that deal. We come into the picture as an intermediary, and more banks, for example, 3 banks in Houston that I know the chairman and the CEO of, they all turned to me and said, well, we're going to come to a stage where we will start investing with you because we will have so much money available in banks that we will not be able to place. And you know the spread. I mean, you've been in business long enough. You know how the spread in the marketplace works. I mean, banks are making it out like crazy. Even in these times of foreclosures, they don't give a damn. And the more foreclosures we are working with banks, we realize banks are not subsidizing your deals. They are still making money on an overall, approximately about 750% is what they make in an overall 1-year structure. So yes, it's a service, it's from an investment perspective, but I'll tell you again, this is the time to invest. Franchises are begging and pleading for money. This is the time to invest. And I want to touch upon something else, a question you asked earlier, is we have, because we are a reasonable sized financial industry firm, we have built our own software to manage our own buys, manage our own sells, manage our own investments. We do our own underwriting. We have our own CPA, we have our own CFO. We do all the underwriting ourselves. And all that is done through personal portfolio analytical tools that we have built through all our years of experience.
So are you acting as a brokerage in all this, or are you acting as a holding company?
We are the principals. We are not a brokerage. We are the principals. The money from the investment group comes into our account, our capital account, and we are the ones that loan the money out. So the money comes into our company, our holding organization. We are responsible for that money, and we are also responsible for the project.
And how do you guarantee the security of the money that comes in? Like, do you guarantee them the 4% or 6% or whatever?
Absolutely. It is a contractual guarantee for the money that will be given or the return of the money. Now, also in some cases, let's say I'm going to use an example. Somebody is coming to us to borrow $50 million to do a development. We could break that 50 million into 30% of that could be debt, 70% could be equity. If it's debt, there will be a percentage of 6%, 7% that they have to pay as interest on the debt. But the equity is a full percent of equity. So if you're an investor and you want to invest $2 million with us and you prefer to invest this at debt, you will be guaranteed a certain rate of return. If you prefer to invest that money with us as equity, your money is locked for 4 years, and whatever is the project equity that we've negotiated with the developer, you will be a limited partner in that project equity. So if we have, say, 75% of the entire deal, 25% being with the developer, you will probably have 20, 25, or maybe even 30% of all the profits that we make. So the larger groups, the larger investors, the larger financial planners are begging and pleading. So I'll give you a live example of something that happened today. We presented 2 deals to a very large group. And we do not present deals to more than 2 groups at a time, because when both groups come and say we want to fund, then it creates a problem for us, and we learned that the hard way. So that group came up to us and we presented an $85 million project. And then we presented another one, which was a $10 million project. So total 95 million. They love the deal. They want to do it. Money can be funded in 60 to 90 days. But they had one criteria. We need minimum $250 million of deals to be funded. So go there, package $250 million of deals to be funded, and we will fund those deals. So there's plenty of money out there. You just have to tap it in the right way. Banks, in my opinion, this is my humble opinion, banks have to reorganize themselves as to how they're going to loan money. Now, banks are always going to be required because there are smaller deals, smaller investors. We are focusing on the mid to semi-large investment opportunities that are coming up to us. But to answer your question, yes, your return over the 4 years is contractually going to be put down. So you will get that return. Your equity return contractually will be put down, and you will get that return as well.
One final question. You mentioned about the 2,600 homes coming up in the Galveston area.
Correct.
Just as a follow-up to what you said, I was just wondering, you talked about this being the best time to invest, but how are you looking at real estate as an opportunity, as a business opportunity versus all the other real estate sectors? Do you see this as being frothy and risky, or do you still see opportunities even in real estate? Because in the Seattle area, it's absolutely going crazy. We're becoming another San Francisco.
So first of all, you know this, being a seasoned businessman, you always make money when you buy. You never make money when you sell. Mm-hmm. So if you buy right, you make money right. Same thing with investments. So for example, let's focus on the 2,600 homes that they are building over 1,100 acres. So the city and the county of Galveston has been after this developer and been working with them for over 2 years, that all those neighboring areas over there are completely going crazy. Developments are coming, apartment complexes, town centers are springing up, gas stations, large Buc-ee's and those kind of gas stations are coming up. More and more land is being utilized, but people are trying to move more, and this is a trend we've realized. People are trying to get out of the hardcore town areas and trying to move a little away. And more people are moving to Lamar, Santa Fe, Galveston, those areas in the Houston area. So city is saying, wow, if you're going to build 2,600 homes, we will approve it. And the city is almost 70% there with us. They give us all the tax benefits. They're going to give us property tax benefits. They're going to help us with eminent domain. They're going to help us with taking over land, expanding. So city is virtually telling us, we will give you all the benefits that you want. All the MUD benefits, the municipal utility district benefit, the TERS benefits, the PUD benefit, planned urban development benefit. We'll give you everything. You just come in with your experience and expertise, build these homes. We need more houses. And it was the inventory, especially in Houston, since we talk about Houston, the inventory was killing us because there was no inventory. In the last 1 year, because of COVID, inventory was zero. But now, this guy that wants to build 2,600 homes, he's a seasoned developer with 45 years of experience, has built multi-million dollars of development. Where is he going to get $75 million to build this? And even though he doesn't need 75 million in one shot, he needs 30 million to buy the land, and then he needs the rest of the money. And it's a huge development. It's going to be a 12-year, I anticipate will probably go up to 15. But we have a program for our investors, whether they are international or local, to come in, stay for 2 years, 3 years, 4 years. Maximum, we want to lock investors in 4-year periods. and put in as equity or put in as debt. And then they get those maximum returns, and then we can restructure, which is where the capital restructuring comes in. And I have to also tell you this, the reason, knock on wood, we are getting more and more entrenched in this, because one of my partners is an attorney who specializes in international finance. So he specializes in moving legally money from one place to the other. My other partner has been an investment banker with 45 years of investment banking experience. He had 600 investment bankers working under him. And I'm a business strategist, and I'm a marketing and a branding expert. So I'm the guy that builds the pipeline, gets everything in the door. We do the underwriting, the three of us ourselves with our team of people. We go and get the financing. So it's like a well-oiled machine that we've built. And as we're approaching more and more governments, city governments, county governments, somebody mentioned earlier about a big development that's going to happen on a 200-acre property. That's what we specialize in. You get 100% financing, investors are happy, developer is happy, city is happy, and we can help structure where city gives you the maximum benefits, which get passed on to the developer as well.
Folks, thank you very much for all the questions. We're running really late. If you all don't mind, if there's any additional questions for any of the speakers, if you all could contact them one-on-one, we would appreciate that. Yasmin?
Yes.
Did you want to close out the session?
Sure. Shall I just mention about the membership dues first? The
Please,
membership is due for 2020 calendar year. The membership includes a member and a spouse. Please send your checks addressed to WZCC Houston chapter and mail it to me. We have sent you all a flyer through the ZAH. And the other membership that we have introduced is a lifetime membership. It's a great deal for seniors who are over the age of 65. It's only $500. And under the age of 65, it's $1,000. Corporate membership is $2,000, which is lifetime. And for the corporate membership, you can send 2 persons for every meeting, any 2 persons each time. So we will appreciate you sending us the checks. And in closing, on behalf of WZC Houston chapter, I would like to thank our very experienced speakers, Berzin Bhandara, Nozer Buchia, and Zal Sethna, for sharing interesting strategies, opportunities, life insurance information, and cautions also during this time. And a special thanks to all of you attending this Zoom session, taking time from your evening. We hope we can meet all of you soon in person, and good night.
Good night.
You guys, good night.
Thank you. Good night.
Good night. Thank you, everybody.
Thank you.
Bye.
Thank you.
Bye-bye.